All right, Jared. Most investors are familiar with market cap weighted index funds. How do you articulate Dimensional's similarities and differences with that approach?
Yeah, I always start with investment philosophy, Ben. And I think that there's two things about an investment philosophy. One, that you have one, because you're going to go through time periods where returns are strong and when they're disappointing. So you need to have something to ground you so you can become a long-term investor. And two, that it gives you a framework to make well thought out investment decisions. So when you look at Dimensional's investment philosophy, there's probably three core components. One is that a rules-based approach is a good approach. And that means that you can articulate what the rules are to financial professionals. You can set expectations appropriately. You can give tools for financial professionals to monitor that you've done what you said you would do. So we think a rules-based approach is a good approach. Second item, that prices are predictions of the future. They're forward-looking. There's a lot of information in prices. Use it to improve returns or manage risk. Prices change daily. That means that you need to have a daily process if you want to use the information in market prices effectively. And the third is that flexibility has value. So markets change every day. You may want to adjust your portfolio a little bit every day. And that flexibility can really reduce frictions, reduce implementation costs. It has a lot of value if you use it in the right way. So when people think of Dimensional and you compare us to an index-based approach, I think that we're both similar in that we start with a set of rules. Dimensional's rules are probably, in my view, more detailed, more involved, more dynamic, more able to cope with different market conditions. And then we probably depart from there in that we have a daily approach because we're using prices to improve returns, manage risks every single day. So a little bit of turnover every day, unlike an index-based approach. And we have flexibility in how we make those trade-offs day in, day out, whether it's what stocks we want to buy or sell, what bonds we want to buy or sell, how we trade those, how we minimize price impact. So all of those things make a difference in the long pull to net returns, and I think are a hallmark of what we do. We consider ourselves master implementers in terms of how we can take an investment thesis and bring it to life in the real world.
Okay. And that's what we want to focus on for the rest of this conversation is net returns, which is something we've been thinking a lot about. Can you talk about what the components of net returns for an investment product are?
I can, and I'm going to start with a little analogy, a story from my misspent youth, let's say. So back in the year 2000, I was 24, so a lot younger than I am now. And my wife would probably argue with this, a lot more dumb than I am now. She might say, no, not really. But I wanted to start learning how to ski. So I moved to the US in 98. I was in grad school. Most of my friends were Europeans, French, Spanish, Swiss folks. They all could ski. And I said, well, this season I'm going to learn how to ski. Never skied before because it wasn't common in Ireland. And so didn't have a lot of money. And so what did I do? I went on Craigslist and I looked to see what could I get for the least amount of dollars. And I ended up buying skis, bindings, boots, and poles for $100. And I often say that's the most expensive $2,000 that I've ever saved. Why? Because took off not knowing anything about skiing and went off with my friends. And within about 5 or 10 minutes, got the ski trapped, fell sideways and tore my MCL and ACL, so 2 ligaments in my knee. And got shipped down to the hospital and they looked at the skis and they said, where did you get those skis? They're from the 70s. And the bindings had no release mechanism. So once you get your ski trapped and you fall, you were done for. And it's an interesting analogy to investing because here's me, I knew nothing about skiing. And rather than asking somebody for advice, what ski lens should I look for? What should I look for in bindings? What should I look for in boots? How should the boots fit? What kind of lessons should I get? I just went straight ahead and tried to do it myself. Now, there's an example of where the price that I paid was not the cost of the entire experience. I had 2 surgeries, lots of PT. I still do extra work on my right leg to keep it up to strength with my left leg. This is 25 years later. And so, that's, as I say, about the most expensive $2,000 that I ever saved. Now, when it comes to the components of net returns, we often think of 4 groupings. And there's 2 that increase returns and 2 that decrease returns. The 2 that increase returns, one is asset allocation. How do you weight the securities in the portfolio? What securities do you choose to exclude? And how do you make sure you get the maximum amount of market exposure possible given the mandate? Right? That's asset allocation. Then you have a second piece, which is implementation. How do you decide when to buy a security, when to hold it, when to sell it? What do you do with securities lending to maximize the revenue for the end investor? How do you decide on different types of corporate actions and your stewardship approach to improve returns for the end investor? Those two groupings, they increase returns if you do them right. Then you have two groupings that decrease returns. One grouping is around kind of implementation costs. What are the explicit and implicit costs to trade? What do taxes look like? Are there ways that you can make yourself more tax efficient? What opportunity cost or style drift do you have in the strategy? They're implementation costs. And then you have the expense ratio. The expense ratio reduces returns. Now, a lot of people focus only on the expense ratio. And they say lowest expense ratio is what I want for my clients. And, I think that you miss large portions of what drives net returns when the focus is only on expense ratio. And we're going to get into a lot of that here today. But I often hear it that, I'll go for the lowest commodity type pricing in areas where I don't think there's much value to be added, like the US market. And again, we're going to talk a lot about that today. But even in the most liquid market in the world, there is still plenty to be gained by implementation. And I think that, it's the analogy that I would use is, why would you put your clients in $100 skis? Why? There's no good reason. It may work out just fine. And if you pay $2,000 on the skis, it may work out poorly. Like, there's no guarantee. But why would you not put them in the best position to succeed? And I think that's the same analogy here. When you have a myopic focus on expense ratio only, and you forget about the other components of net returns, you may be leaving returns on the table that your clients could quite reasonably enjoy.
So let's talk about the market. What decisions go into defining the market when creating an investment product?
Yeah, so let's start at a very high level. And at a very high level, really, it's how low do you want to go? And what do I mean by that? It's what market cap do you want to include? What lowest level of price do you want to include? What lowest level of liquidity do you want to include? Those types of decisions can go into defining what's the eligible market for this investment strategy. And differences in those decisions can lead to large differences in the number of securities that you might want to include in an eligible market. But that's kind of at a high level. There are some things that define the market. Now let's dig down a level. Digging down a level, let's think about free float. What's free float? Well, free float is this concept whereby a company may have $1 million market cap, tiny company, unless true $1 billion market cap, still a small company, $1 billion market cap. But not all of that market cap is available to outside investors. Let's say half of it is held by inside investors. And so the free float might be half. And so how you choose to weight that in the market then may be at 500 million rather than $1 billion. Well, the free float and how it's done can make a big difference in portfolio weights. So I'll give you an example. If you take the global market and you don't free float any security, the US weight is about 50%. If you free float securities, typically the free float for non-US companies is lower than the free float for US companies. So the US weight goes to about 65%. It can make a big difference in terms of the composition of the overall portfolio, something that a lot of people I don't think appreciate fully. The last comment that I make then is that the market is dynamic. It changes every day. And therefore, whatever definition that you have of the market, it needs to take into account the latest information so that it's current. I'll give you some examples. Globally, there's probably about 1,000 mergers announced a year in public markets around the world. And that means that companies are being bought by other companies, and that changes the nature of the market. You have to pay attention. Again, globally, if you think about IPOs, a little bit fewer in the US, maybe more outside, maybe on the order of about 1,000 IPOs in any given year, globally, right, on average, sometimes higher, sometimes lower. When you look at a plain market portfolio and you think about the dividends and you think about the corporate actions and those types of events, you're talking about 5 to 10% turnover in a plain market portfolio. So the market changes every day. So that means that whatever your definition of should recognize that it's evolving, it's dynamic, it's something that needs to be looked at every single day. But how low you want to go, I think, is the biggest input into what defines the market.
It's so common to hear people say, just by the market. But as you just noted, there's a lot of different ways to think about that. You mentioned the free float example. How much of a difference, maybe other examples, how much of a difference can there be between different definitions of the market?
You know, you might look to different index providers there for different definitions of free float, because every index provider, if that's what you're using as your kind of step in or stand in for the market, it will have a slightly different definition of free float, and they'll apply different criteria. Some of them are a little bit subjective, some of them are very reasonable. Like, for example, for Thai securities, there's foreign withholding limits. So there's only a certain amount of a company that foreigners can hold. So if you're an index provider providing an index for investors all over the world, you're going to take into account that foreign withholding limit. But then there's probably a little bit more subjectivity in how much might be held by insiders and things of that nature, that you may have slight differences across index providers. To give you a sense, Ben, and just in terms of how different it might be, not just associated with free float, but in general, like if you were to look at different US broad market indices, so different US broad market indices, and you probably have something like the Russell 3000 or the CRSP market index, or some indices like that, or MSCI broad market index, and you look back over the past 20 years, you would have had on average a return difference between those three indices, between the highest returning one in each year and the lowest returning one of each year, of about 30 basis points or 0.3%. That's the average. But it's been as high as about 1%. And that's in the US, which is a single market, where the free float probably lines up more similarly across the different providers. You go to non-US developed, that average difference jumps up to about 1%, where you'll have differences in any given year of 3 or 4%. And there you would look at FTSE indices, you look at MSCI indices, S&P indices, they all have broad market indices. And if you go to emerging, it jumps up to close to 3% is the average return difference between the highest and the lowest any given year, with some years as high as 6-7%. So that kind of gives you an idea of how in these small differences in definition can lead to differences in returns in any given time period.
Yeah, it's crazy. And those were total market examples. How much more pronounced can those differences be if we go to like value or small cap value indexes?
Much bigger. And when you go to small cap indices, let's take the US as an example again, in small cap indices, if you look back, you take the CRSP small cap indices, the Russell 2000 and S&P small cap index, and you look at the highest to lowest each year, and then you average that over the past 20 years, it's been about 5%. And in some years, it's been higher than 10%, that difference, in terms of the highest returning index to the lowest returning index. And you can see that in characteristics. Like if you look at as the end of last quarter, which would be the end of quarter 1, 2025, and you were to look at something like the CRSP index, its weighted average market cap was above 8 billion, whereas the Russell 2000 was probably closer to 3.5 billion weighted average market cap. So there's two small cap indices, but because of the way they define the small cap market, they end up with very different return outcomes.
So how does Dimensional define the market?
Well, we start with how low do we want to go? And typically when you look at a dimensional portfolio or a dimensional strategy, we typically go lower than many others. So in the US, we might go to 10 million free float market cap, or outside the US, maybe 50 to 75 million free float market cap. And so that's typically lower than many indices out there. And I'll get to why that's important in a few minutes. Then we're going to look at other things like exchange listing standards. And things that we're looking for there are, what are the investor rights and investor protections and the amount of disclosure and so on in each exchange. Typically we end up with a smaller number of exchanges than maybe in some indices because of that criteria. Then we're going to look at where stocks may be close to being delisted. So, for example, stocks trading at $2 or less here in the US, and that changes dynamically. But we're cognizant of we don't want to include a lot of things that may be close to getting delisted in the universe. And then you may look at other things like free float and how much is available for outsiders. Because if, let's say, a company is 90% held by insiders, there's the worry that the expected return for the insider might be different from the outsider because they're tunneling assets to their own benefit. So there's those types of considerations that would go into effect. So if you put all that together and you say, what does a global portfolio look like? And then you can look at some of our strategies. But probably, in a global portfolio, so that's US, Canada, developed markets outside of North America, emerging markets, you're looking at about 13,500 different securities, different stocks. If you look at the MSCI ACWI IMI, so that's all country, and IMI means large to small, you're looking at about 8 to 8,500 stocks. So there you're talking about quite a large difference in the number of stocks that would be included in our universe. And you say, does it make a difference? It's not a massive difference in market cap, but here's why it makes a difference. When you look at implementation, when you have more securities to trade on any given day, it gives you more flexibility of what to trade. And so it's helpful, and we'll get to this later, driving down trading costs. When you look at securities lending, in some markets, securities lending is driven by what's called general collateral. And that's a volume game. It's how much can you get out in loan at any point in time. But some markets are driven by specials. And that's not a volume game. You never know which stock is going to go on loan at special. So emerging markets is very much driven by specials. And so there, if you have a broader universe, you probably can do better on your securities lending revenue. And then there's also a tax consideration. What's the tax consideration? Because in strategies, you may want to harvest some losses, you may want to realize gains in a particular way, it gives you more flexibility to do that. I think that where the trade-off is the cost of holding such a broad universe. And that goes beyond custodial costs, because we have very, very robust systems to take in current information about all those securities, about their financials, and news checks about all of those stocks. We can do in-depth analysis on all of those stocks. And that really enables us, from an internal management perspective, to actually be able to efficiently manage a portfolio with that number of securities. So the cost is not too high for our strategies, but the benefits, in our view, are there and positive.
So you've got this big, deep universe of securities. How does Dimensional decide which, if any, securities you're going to exclude from that universe?
Yeah, there's a few things that go into that decision, Ben. One would be expected return considerations. And is there evidence? So let's back up a second. Dimensional uses historical data not to understand the past, although it does help us do that, but to predict the future. So is there something that we see in the data over the past 20, 30, 40, 50 years that we say we would have expected to see it there because of the way we believe the world works? We saw it there. That allows us to quantify the magnitude, and we would expect to see it going forward. So there may be small groups of stocks where we expect the return of those stocks to be much lower than the rest of the market, and you're not giving up too much diversification by excluding those stocks. So it's an expected return consideration. Another consideration is a tax consideration. So are there stocks that are less tax efficient than other stocks? And if there are, can we put together a strategy that excludes those stocks and one that only includes those stocks, so that advisors can choose to put the one that's less tax efficient in a tax qualified account, and then the other strategy in a taxable account, so that they can have a better after-tax set of returns for their clients, right? That's the second consideration. Another consideration then on that front might be asset category, where something is kind of a different asset category. And we'll get into REITs in a moment, but REITs are kind of a different asset category where, you're passing through over 90% of your rental income straight through. It's more of a pass-through vehicle. And you're not retaining as many earnings. It's not like a typical C corporation. And so it's kind of giving you exposure to direct investment in real estate of that rental income. So kind of like a different asset category. So should you treat it a little bit differently? So those are some of the considerations that would go into deciding what should we include in the universe once we've defined how low will we go and what shouldn't we include.
Can you expand on that a bit, Gerard, and talk about what types of securities you actually exclude at Dimensional?
Yeah, we can. So let's go down the list a little bit, and let's talk about the expected return consideration. If you look among small cap stocks, and you look at those small cap stocks that historically have had very high relative prices, so they look very growthy. They're trading at a high price relative to a company fundamental like book value or earnings. And they also have very low profitability. Well, those stocks have underperformed the rest of small cap stocks by about 5 to 10% a year historically. How much of the broad market do those stocks represent? About 1%. They're not a massive market cap, but they do have significant underperformance, and it matches with what you would expect. Let's suppose that you think the world is kind of a fundamental valuation framework of explaining things, and you have something with a very high price, very low profits. If profits predict future profits, and they do, then that's low expected cash flows to shareholders. That means low discount rate. So you would expect those stocks to have low discount rate, low expected returns, and they have had low historical returns. And so we exclude those from purchase. Another grouping is small cap stocks with high asset growth. So how do you grow your assets by a lot? You retain a lot of earnings, you issue a lot of stock, you issue a lot of debt. That's how you grow your assets. It turns out that companies that tend to do that over the past 3 to 12 months tend to continue to do it over the next 3 to 12 months. Well, guess what? If you're retaining a lot of earnings or issuing a lot of new stock, there's fewer cash flows for shareholders. So high asset growth, all else equal, would imply lower expected returns. And historically, they have underperformed the rest of small cap by about 5 to 10% a year. So again, that's about 1% of the total market cap. We say, okay, let's keep those out of the portfolios, or out of a broad market portfolio. So that would be a couple for expected return reasons. And there's more, but we can dig in there a little bit later. If you look at a tax reason or an asset category reason, actually these goes together. You might think of something like REITs, so real estate investment trusts. And when you look at REITs, and I'm going to use a US analogy, but this varies by region. And so in some regions we will include REITs in the strategy, in some regions we won't. But let's use a US example. So in the US, if you think about REITs as, let's say, being 2 to 3% of aggregate market cap in the US, give or take. And the yield on REITs is, between 4 and 5%, whereas the rest of the US market is like 1.5%, some number like that. And then if you look at the tax rate that is applied to REITs, because in the US, they distribute a lot of what's called non-qualified dividend income, taxed at 40%, whereas most stocks will produce qualified dividend income taxed at 20%. So now you have this increased yield of about 3%, let's say, a tax rate differential of about 20%. So if you take REITs out and you have a separate REIT strategy, put it in your tax-deferred account, you save yourself about 5 basis points, give or take, on after-tax returns. So there's a tax reason that you say, there's nothing wrong with REITs. We think they have about market-like expected returns. But let's do something from a financial engineering perspective that gives tools to financial professionals that they can optimize the tax profile of their client. So that would be another example that fits into the asset category plus tax consideration.
Can you talk about why IPOs are excluded immediately after the IPO?
Yes, we also exclude IPOs immediately after the IPO. So probably it's good to use an example there. And the example I would use is Rivian. And that's from a few years ago. It IPO'd at about $100 a share. In the first day or two, it climbed up to about $170 a share. And then afterwards, it declined and declined. And now it's trading at, well, whatever. It didn't have the best stock price experience of all IPOs. And that's a bit of an extreme, but it illustrates the point. When you look at IPOs, there's a few things that stick out. One is that they often have good first week returns after the IPO lists. And then if you look after that, in about the 6 to 12 months after, they often have relatively poor returns or underperform the market in the 6 to 12 months after. Now, it depends on how you measure. So whether you use calendar or event-based studies, you get slightly different outcomes. But when you look at their characteristics look like small growth, low profitability, right? So that kind of gives you an idea of why you might expect them to underperform. But then there's other things that happen. So for example, at an IPO, the insiders might be locked up for the first 6 months. And so in 6 months' time, you may have a lot of stock that's coming to market. So a significant change in the free float over that first 6 months. And so that's an event that will happen. You may have some aftermarket trading support for the investment banks right after the IPO is launched. If you can't get in for that initial first week, which most people can't, and if you were trying to get in, you have the problem of selection bias in that you're working with investment banks. Are you going to get allocations to all the good ones, all the bad ones, or a mix of both, right? So there's some selection bias there. So our view is that when it comes to investing, you almost always have more time than you think. And I think that's a good philosophy in life in general. And so we wait about 6 to 12 months, and there's analysis done before including an IPO in the portfolio. But that's a reason that we would exclude IPOs from the investment strategies.
You mentioned 6 to 12 months. How is that decision made about when it's going to get added?
That's a portfolio manager decision. So we have within the firm, we have a financial data working group, and so that provides all sorts of data across this broad universe that I mentioned that serves it up very efficiently to portfolio managers so that they can understand the kind of specific facts and circumstances for each corporate event or each listing. And with that, then they can make an informed decision. Okay, after 6 months has passed, all the insider lockups are done. The thing seems to be trading more like normal. Is this the right time to include it, or should we wait a few more months? So it's a PM decision.
So I'm curious, Gerard, what proportion of the market or the defined universe is actually excluded, in a typical broad-based market dimensional portfolio like the core fund?
Yeah. So let's take the US, and then I'll go outside the US for an example. Probably when you say, how low do we go? So that first piece, how big is the market? In terms of number of stocks, it's probably about 3,500, give or take. And then when you take into account the REIT exclusion, IPO exclusion, when you take into account some of the small, low profitability growth exclusion, the high asset growth exclusion, you're probably down to about 2,500 stocks, give or take. Now, that's not a massive percentage of market cap. So the small high asset growth and the small low profitability, that's probably at 2% between the two of them of market cap. The REITs in the US is 2 to 3%, right, depending on how REITs are. The IPOs will vary over time depending on the activity in the IPO market. So you're getting pretty broad market cap coverage where you're probably at something like, I want to say around 55 trillion. Is kind of what you might think of the eligible market cap that will be available in the US. That number of names is quite similar actually for developed markets outside the US and emerging markets. There's about 1,000 from the starting to the end. But there you end up with far more securities. Developed market outside the US, you're probably like 4,500, and in emerging markets, you're probably like 6,500, 6,000, somewhere around thereabouts. So you're ending up with a lot of stocks and the vast majority of market cap. But you are refining, and you're making what I would say a better starting point for investors.
So it's a pretty low proportion of market cap that's getting excluded.
Mm-hmm.
How impactful do you expect those exclusions to be to expected returns?
Yeah, I would say that, let's say you're doing a plain market cap weighting strategy, and you say that small high asset growth and small low prof growth underperform the rest of the market by 5 to 10%. And it's 2% of the portfolio. Okay, that's 10 to 20 basis points of expected outperformance. When you look at the REIT exclusion for the US as an example, I mentioned a number of 5 basis points in after-tax returns. Okay, there's 5 basis points there. When you look at IPOs have typically underperformed the broad market by on the order of 1% a month after in that first 12-month period. So that will vary depending on how much IPO activity there is. So all of that in a broad market portfolio, you might be talking on the order of 20 to 30 basis points, somewhere in that neighborhood. But then when you go to an asset category like a small cap, then it can be even bigger, and those decisions can be more meaningful in terms of the level of return deviation that you will get year on year, but also in the level of expected outperformance that you would get from those decisions year on year. But in a broad market, 20 to 30 is probably not a horrible estimate. I'm using a wide range to make sure people realize that it's an estimate, and that all estimates of expected returns are noisy, and therefore wide ranges are appropriate.
I would guess that most listeners know that a small portion of stocks are responsible for a large portion of the realized returns. So you talk about how risky you think it is to exclude parts of the market? Yeah,
I mean, the first thing that you have to keep in mind with that, Cameron, is opportunity cost. And I always love the analogy from Professor Kevin Murphy at the University of Chicago, which is it a bad thing if your kids watch 5 hours of television a day, or a good thing? And the answer depends on what else they might be doing. And so if what they might be doing is you're teaching them mathematics, reading them poetry, they're learning a musical instrument, it's a horrible thing. If the alternative is that they're out in the streets getting into a gang and getting into all sorts of mischief, it's a great thing. So it's all about the opportunity cost. And the first thing that I think you have to keep in mind, Cameron, is that there is no strategies, or are no strategies out there that don't exclude some portions of the market. Every strategy, whether it's an index market or a traditional active or dimensional, all of them are excluding portions of the market. Dimensional is very intentional in what portions of the market is excluding. It's excluding portions of the market that we think will contribute to returns over time. We're very intentional in how we do it. So I mentioned in the US there's 1,000 names. Those 1,000 names represent a few percentage points of market cap. Therefore, it's not like we're excluding Apple. Let's take Apple out of the portfolio. And therefore, the performance of Apple can make a big difference on what the returns are over any given time period. You're spreading that over many, many names. And so you put yourself in a way better position to get the average outcomes that you've seen historically, because you're doing it in a very diversified fashion. So I think that the way that you do it matters, and being intentional about why you're doing it matters, and recognizing that there is no solution out there that doesn't exclude some portion of the overall market.
Okay, so I got to ask, you kind of spoke to this just now, but I think any traditional active manager would say that they're also intentional about what they exclude. Can you talk about how these exclusions that we're talking about are different from traditional active management?
Yeah, and I'm going to use another analogy here, and I think that hopefully it will be helpful for part of the conversation. And something that I love is baking shows. Now, people often ask, why do you like baking shows? You don't eat any sweets, you don't eat any desserts, you don't eat any puddings, you don't eat gluten, you don't eat dairy. Why do you watch baking shows? I just like them. I don't know why I like them, but I do. Maybe it's the forbidden fruit. I don't really know. In any event, I love the Great British Baking Show. And I don't know if you're familiar with that show, but in each episode, there's 3 rounds of competition. And in one of the rounds is called the technical. And in that round, every baker is given the exact same ingredients. Every baker is given the same recipe. And every baker is told to produce the same bake. So let's say, for example, it's a ciabatta bread, and then they're all told to produce a ciabatta. But the recipe is not complete. So it might not tell them how long to knead the dough for, or it might not tell them what order the ingredients should be added. Or it might give them an oven temperature, but not tell them how long it should be in the oven, right? So the recipe is incomplete. And then what happens? They get judged based on criteria, which are, what does the crumb structure look like? What does the color look like? How good is the bake? And who wins? The best baker. And investing is not actually all that different. Whether you're traditional active, you're dimensional, or you're index, we're all starting with the same ingredients. And we're focused here on market portfolios. So we're all trying to produce the same thing. We're all trying to produce the same bake. But it comes down to who has the technical expertise to produce the best bake, because the recipe is very unclear. When it comes to investing, there is no perfect rule book that says this is exactly how you should invest. It is very unclear. And so when you think about traditional active and you compare it to dimensional, what are some of the differences? When we do something, it is based on very, very strong empirical evidence and very, very strong theoretical evidence. So that when we do it, there's high confidence, and we can show you the evidence and the reasons why you should expect this in the future. Traditional active is predicated on a proposition for which there is no evidence to support. That's a proposition that you can make money by outguessing market prices. We have seen the evidence time and time again that show in the aggregate that is not a winning proposition, and that show you can't identify those traditional active managers in advance that may have enough skill to cover their costs. Right? That evidence is overwhelming. It's very, very strong. And so when I think about those differences, we're doing it in more of an engineered fashion, where it's either evidence about expected returns, or it's the goal of the portfolio when people tell us taxes are important to us. How can you make us more tax efficient? okay, I can go back into the lab and figure out how to make your strategies more tax efficient without taking on too much tracking error for you, and then show you ways to locate assets to make you more tax efficient. So it's a very different kind of a mindset and a value proposition that then ends up being a better investment outcome, in my view, for the end investor.
Yeah, that's a great answer. I would say that's a pretty important difference.
Yeah.
How does securities lending affect portfolio implementation?
Yeah. So we kind of touched on this earlier. So let me go back, and just in case there's not a lot of familiarity with securities lending, what is it? So let's suppose Dimensional is managing a mutual fund or a Canadian fund or any of those funds on behalf of the end investor. And we have well-diversified strategies. We have low turnover strategies. We're not beholden to any index. So that flexibility is important, and I'll get to it in a moment. And so somebody comes and says they want to borrow a stock. And they may want to borrow a stock to settle a trade. They may want to borrow a stock to short it. There can be many different reasons to borrow a stock. And we say, okay, you want to borrow a stock. What are you willing to pay the investors in this portfolio in order to borrow the stock? And so that's a market like any other. We maybe some negotiation, but we get to a price of effectively how much revenue is the portfolio going to get for loaning out this security. Now, if you look across Dimensional's equity complex, last year was about 4 basis points in return was added by securities lending revenue. Now, that varies by market. The US market in a broad market portfolio, it's around 2. If you're looking at developed markets, it's about 5 to 10. If you're looking at emerging markets, it's about 15. It varies by market, right? So it varies by market and can be meaningful in certainly different markets. And they're all broad market portfolios, by the way. So that's all just broad market portfolio kind of lending revenue, and it can vary by market. And so Dimensional does a few things that I think are important. Number one, Dimensional does not keep any of the lending revenue for Dimensional, the advisor. We have agents. The agents have to be paid. All the remainder goes to the end investor, none to Dimensional, the advisor. So there's no conflicts there. Other things that are important, though, for the way that we invest is because we have such a diversified group of securities, and that we have low turnover, and that we have flexibility not to have to sell a stock at any particular time. That means that we're very attractive to many of the borrowers out there. They like to use our portfolios to borrow securities from. Because let's imagine in an index fund and you're loaning out security XYZ. You may not want to loan out as much of your position as you otherwise would, because what if you have a redemption and you have to sell everything pro rata because you're trying to manage tracking error? If we have a redemption and one stock is out on loan at a very high fee, well, I don't have to sell that stock right now. And that type of characteristic is attractive to borrowers. And so you can command higher fees, better utilization. And as I said, general collateral is more of a volume game. And right now, the US is more of a general collateral game. You remember from GME from a few years ago and all the shorting and what happened to hedge funds. So the US sec lending revenue has gone off over the past few years. It may come back, but right now it's around 2-ish. Outside the US in developed markets, it is a general collateral game again, so it's a volume game. Emerging markets is much more specials. And so you have to have the diversified securities, and then things just go on loan at a very high fee. And if you don't have them, you can't get that revenue. But if you do have them, you can.
So you mentioned what makes Dimensional attractive for people who want to borrow securities. Do you know how your securities lending revenue compares to other product providers?
Yeah, I mean, you can look at Morningstar, and you can look at Morningstar category averages for those types of numbers. And the category average kind of masks that there's lots of variation. But in the US, you're probably looking at a half basis point in the market portfolio. So not a massive amount. It's a small amount in the US. When you go outside the US to developed markets, it's probably closer to 5. When you go to emerging markets, it's probably closer to 10 in terms of how more relative to the Morningstar category average a Dimensional strategy would be getting in lending revenue for the end investor relative to what that Morningstar average is. And again, as I said, you will find variation across manager. It will vary, so you'll just have to do your due diligence there to see what the lending program looks like and how much is contributing to the returns of the portfolio.
How do things like corporate actions, proxy voting, engagement with portfolio companies affect the implementation and also the net expected returns?
Yeah, those are important too. And I think that it's probably best to illustrate with an example. You remember I said earlier on that there's about 1,000 merger announcements in a given year. Not all of those are for cash, but many of them are, especially outside the US. Probably more of the mergers outside the US are for cash than in the US. But let's suppose you have a merger that's for cash, and the market thinks this is going to go through for sure. So the announcement happens. The stock that's the target, let's say it's trading at $20. The announcement is for 25. It's for cash, and the market thinks this is going to happen for sure. That price pops from 20 to 25, and then how do you think it trades between the announcement and the consummation of the deal? Trades like cash. When you look at small caps in particular, and you see the amount of merger activity, it's about, on the order of 2% of small caps are kind of in play for mergers, especially for cash globally at any point in time. So there was an example that we had from October 23. It was called Energy Smart, I think was the name of the firm. And it was in the Russell 3000, and it closed the deal in kind of January of 24. And over that time period, the Russell 3000 was up about 16%, so a pretty good return. And it traded for cash during that whole period. So what do we do here at Dimensional? Well, we're looking every day for those types of announcements. Then depending on the announcement, whether it's for all cash, whether it's stock and cash, we're going to do an analysis. And we're going to be looking at the price reaction in the markets to this announcement, because that gives us a lot of information about the probability that this announcement and this deal will actually go through. And depending on the market reaction, we're going to make a decision. And that decision might be, well, the market is thinking this is going through at high likelihood. We've already gotten the price pop. We don't want to have 2% of our small caps with cash drag because they're all in M&A mode. And so let's sell this stock way before the deal consummates. Then we're going to make decisions on how to sell it, because we have a lot of different tools. Are we going to try get this stock out in kind so that it's a stock that we want to sell, but can we sell it without realizing a gain? Oh, that's a nice tool to have. Or if it's in a Canadian portfolio, well, what's the CGRM going to be at the end of the year, and how are we going to work that in to make it more tax efficient, right? So then there's potentially a tax question. But that's an example of a kind of a corporate action that you can add value to the portfolio. And this goes back, you remember what we said at the start, market exposure in that asset allocation? This is a way that you can have hidden cash inside your portfolio that you don't know about unless you're taking care of the details and making sure that you're trying to minimize that kind of cash drag in the portfolio.
Yeah, that's super interesting. So there's like an implied cash drag in equity portfolios from cash merger activity.
Exactly.
Mm-hmm.